I sit down with Pedro, a Portuguese tax expert, to talk specifically about taxes for retirees and various passive income sources. Is Portugal a tax haven?
If you're coming to Portugal with the idea that you are going to a tax haven,
He clarifies Portugal's highest tax bracket.
they believe they will be taxed by a flat rate of 48%, when that's not exactly the case.
Do foreigners qualify for deductions?
Pensions, for example, get a deduction of almost 4,000 euros per person. So
But what is excluded?
the only thing that Portugal excludes,
I ask for a more concrete example.
Around that 80,000, maybe around 100,000 max. Can you give a bit of an indication of what taxes would look like and how filing works for someone like that?
so
Let's talk taxes and vital considerations such as percentages, the double taxation treaty, and inheritance.
Well, Pedro, we're really going to focus in on passive income and taxes for that. So first of all, can you explain what are some passive income taxes?
So the idea, Katie, is that passive income is classified in different categories in Portugal, but majorly they refer to dividends, to interest, to capital gains. Perhaps if you have rent, it's also deemed as passive income. And if you have foreign sourced, which means passive income that doesn't derive from assets, investments, or property in Portugal, it will be taxed by a flat rate of 28%. It's important to give this perspective because most people believe that they will be taxed by the progressive rate that could go up to 48%, but in what refers passive income, you are taxed on a flat rate of 28%. I do believe it's interesting to mention also that if you have foreign sourced passive income, if the source country where your investments, property, or assets are, if this country taxes your gains derived from the property, if they tax the dividends, the interest, you can use those taxes to offset the 28% that you are taxed in Portugal to avoid double taxation, okay? As long as the country holds a double taxation treaty with Portugal.
Okay, and speaking of the double taxation treaty, does the U.S. hold that with Portugal?
So Portugal holds a U.S. convention, as we say, normally referred as a double taxation treaty. And the idea of the double taxation treaty is precisely to establish rights over taxes and separate streams of income in the different articles of it. For, let's say, the layman, the most important thing to understand is that the treaty protects you from double taxation. And he can do it by restricting the rights of taxation of a certain jurisdiction, depending on if it's the source or the residency. As a rule, residency will tax you on all of your income. However, funny enough, the US has this particular protocol in their conventions that refers that for US citizens, no matter where you are a resident, the US still holds rights over all of your streams of income in terms of taxation. The way that it works, not only with the US, but especially with the US, to avoid double taxation, it's not precisely by restricting the rights of taxation, but providing credits for taxes that are paid in your residency or in the US. In order to understand where you will claim those taxes, then you need to separate each one of your streams of income accordingly to the classification of the double taxation treaty, and to first analyze where your income is being first taxed, or where it is the primary or secondary right of taxation, and then establish where you need to claim credits for the taxation that you have faced either in your residency or in the US, for example. If it's taxes in US, then you claim as credits in your residency that could be on your Portuguese tax return, for example, and you will only pay the difference in Portugal. If you are only being taxed due to your citizenship, then you claim those credits as what we call foreign tax credits method in your US tax returns.
Okay, before we dive into things like Social Security, pension, IRAs, let's talk about that 48% and the progressive scale, because I think a lot of people think 48%, that's so much. So can you give some clarification on, does someone pay 48% at that like 76 $80,000 threshold, or what is that?
Yeah, the idea of the progressive scale is to establish different brackets, and each one of those brackets will be taxed by a different tax rate, a progressive rate that goes right now in Portugal goes to from 13% up to 48%. Some people think that if you have more than the last bracket of this progressive scale in Portugal, which is around 80,000 euros a year, they believe they will be taxed by a flat rate of 48%, when that's not exactly the case, due to the fact that since you have different brackets, each one of those layers of your income will be taxed by the different tax rates, which are lower than 48%. Therefore, if you have an income of around 80,000 euros a year, your effective rate will not even reach 40%. It will be around 36, 35, and you still have to apply deductions to it.
Okay.
Deductions either to your deductions related to the stream of income of itself. Pensions, for example, get a deduction of almost 4,000 euros per person. So, and also personal deductions. So from your personal expenses, in the end, against the tax bill that was created by this progressive scale. However, do not be afraid of this 48% if you are not making, above 120, 150, 200,000 euros a year. Then we will need to work around your planning and find out solutions that will not lead to such severe taxation.
Okay, great. So let's say there's someone who's coming in, they're retiring, they're coming in completely on Social Security, around that 80,000, maybe around 100,000 max. Can you give a bit of an indication of what taxes would look like and how filing works for someone like that?
So, in terms, I will start with the filing, because a lot of people believe that it's as in the US, where you can get even softwares or websites. I'm not going to mention their names because that would be free advertising, but they believe that they can use the same logic in Portugal. When the Portuguese taxes, especially the system, it's not that it's not well developed, but the way that it is shown to the taxpayer is not user-friendly.
Okay.
And that's the perspective. I mean, one can learn to do it, but it's not easy.
Okay.
So it's not rocket science, but especially if you're in your first years, I deeply recommend that you look for someone who understands the double taxation treaty, for example, that understands cross-border taxation, that understands the scenario with the Americans and the taxation with the citizenship, because the way that you file your taxes in Portugal, it's a little bit different from the perspective of the US. So trying to do it with the US mindset might lead to mistakes. And then trying to correct them with our tax authorities could not be an easy task. And then what you would, pay for someone to file your tax returns, you will pay for someone to fix your tax returns, paying a higher bill that you should, and waiting for a refund that could take months.
Okay.
So in terms of the taxation of someone who holds Social Security, as a rule, you will be taxed by the progressive rates. So depends on how much you make on a year to understand exactly how much you would be paying. But given your example of someone who makes fairly, $80,000 a year, around 76,000 euros right now. So as I said, I'm expecting a tax bill of around an effective rate of 34, 35%. Okay. That also depends if you were a couple.
Okay.
And if one of the partners holds all of this income. So it's not a joint, let's say, total income of 80,000. It's 80,000 on one partner and a lower amount or no amount at all with the other partner. In this case, you get to split this income by two to find the tax rate.
Okay.
It's not that only half of your income will be taxed. It's not that. It's that only half of your income will be used to find the rate, which means that with the deductions that I have mentioned, we are looking into a scenario of reducing it to maybe 20%.
Okay.
on an effective rate. That's a huge difference. 28 apply to the 80, not to the 40. That's also something people believe that's how it works, but it's still a lot. You're still saving 10 to 15% depending of how this, let's say, partnership is organized in terms of allocating the income. So it makes a difference.
Okay. And then how complicated does it get if you have, let's say, Social Security, but then you also have a 401k or some other aspects when you piece it together? Is it complicated, or how does that look?
So in this case, it's almost rocket science for some people, but it's a little bit tricky because when we are looking at the retirement accounts from the US, so any kind of pension that it's not derived from Social Security or the government itself, if you have a government pension, for example, then it's a fixed amount. It's not that hard to assume what is the taxable income. In the case of a retirement account, like 401ks, like Roths, like IRAs, it's a little bit tricky because some of those accounts are either fully self-contributed or partially self-contributed with the money from the beneficiaries. So if someone expects to have yields from those accounts and classify that as a pension in the future, since they are retirement accounts, they should account also for what they have contributed with their own money into those accounts. And the Portuguese tax legislation allows you to separate in a distribution from those accounts what is your return of capital, what you have as a return of your own contribution compared to what has of income created inside it. So the yields of the investments inside those accounts will be taxed naturally, or contributions that were not made by yourself but by your employer in the case of a 401k. This is the portion that will be taxed. So as you can see, this must be done to reduce your tax bill in Portugal. Otherwise, you will be fully taxed on everything that is sitting inside, including the money that you have contributed to it. So as you can see, in this case, having someone analyzing the whole idea, the whole structure of even establishing what I need to report. It's not how to report, it's what I need to report. It's a hard walk around. So having someone guiding you on how to do all of that, and it's from my experience with my clients, it's much better when they have someone that they can trust to do that. But at the same time, it's something that it should be learned. So if you plan to spend a lot of time in Portugal, you're already with this mindset of I will keep track of it. I will make sure that I have that on my hand, because we have a lot of clients that simply say, my IRA from 40 years ago, I don't have any paper around that. Everything is stored in a hard drive somewhere in the middle of nothing. So they don't really know. And it's a good idea if you are planning to come to Portugal to try to at least go and track that. If you at least know how much you have contributed, that's enough. Because then we can make the difference of the total amount that is sitting in the account. Work done. So we'll use this proportion on every distribution that you make from one of those retirement accounts, and that's how we report it.
That's good advice, to make sure that you have documentation, because in the end it will help you. Is there any different rule or filing for a state pension versus something federal?
So really, no, there is no difference in terms of classification if a certain income derives from the state level or the federal level in the US. Anything that comes as a pension derived from work that you have rendered to the government, it doesn't matter. It could be the city of somewhere that it's literally paying you, but if it is a state pension or a federal pension for work that you have rendered to the government itself, then it is classified as a government pension. Interesting enough, at least on the US and Portugal double taxation treaty, government pensions are only taxed in the US if it derives from the US, if it's paid to someone who solely holds US citizenship. So if you acquire at some point Portuguese citizenship, you will start to get taxed in Portugal. So it's something that it's important to know, because we have a lot of retirees coming from the US who holds this federal or state pension, the government pension for work they have done for the government of the U.S. and now they're coming to here. And it's interesting because I mean almost all of them comes only with the U.S. citizenship, so they only get taxed in the U.S. You still report your government pension in Portugal, but you don't get taxed.
Okay.
If eventually you acquire Portuguese citizenship, it will start to get taxed here through the progressive rates.
Okay, and does that apply for U.S. military as well?
That applies to U.S. military. The only thing that Portugal excludes from taxation, not only from the U.S. but anywhere in the world and in Portugal too, are pensions derived from disabilities, for example, that were acquired when you were on the military. So what we call it, perhaps it sounds weird in English, but it's a blood pension. Okay, but in the US, probably a veteran pension derived from this specific events that happen, and they are not taxed at all. It doesn't matter where it comes from, it doesn't matter who holds it.
Okay. Now, with the NHR going away a while ago and then NHR 2.0 coming around, I think a lot of those who are retired think, I can't get it. Is that true?
So, it's possible to fit the requirements, but then you need to ask yourself, am I getting any benefits around it? And unfortunately, the NHR 2.0 has excluded pension income from any kind of benefits. So it doesn't matter if you fit the requirements or not, your pension will be taxed by the progressive rates. And that's well established. What we can ask ourselves is, what is exactly classified as pension income? And we can say for sure that any government pension is classified as pension income, and any social security paid to you is pension income. Any income derived from those pension funds from companies. So, for example, you have worked on a company so far and they have a pension plan for you, then those are 100% pension. There is not really a work around that. And we do not advise someone who solely holds those streams of income to have the trouble of getting into the requirements of NHR 2.0. However, if you have a retirement account, like an IRA, a 401k, a Roth, the Portuguese legislation, due to the mechanics of those accounts, they basically establish different treatments for it. I have mentioned about the way that you can separate the return of capital from the income itself, because it takes into consideration the contributions that were self-made. We can also use some particulars from the Portuguese legislation to basically claim that if I take a lump sum from those accounts, if I take a huge early withdrawal, clearly it was not the intention of this retirement account for me to take all this money out, but I have chosen to do so. So even before the 59.5 age, that it's normally the time mark to someone not get any penalties from withdrawals from those accounts, we try to fit that into the concept of a return of an investment.
Okay.
So instead of classifying that as a pension, we classify that as capital income, because that was clearly the return of your investment that you are early withdrawing from a certain retirement account, and not to properly use that for your retirement directly, because it's not a regular payment to yourself. And the Portuguese legislation and the Portuguese tax authorities have given us official guidances, not with those accounts, but with similar accounts especially from European countries, where if you make a lump sum from that account, you need to treat that income as a return of a certain investment. Even if it was in theory for retirement, clearly it wasn't used for that purpose. You're going to use it to buy a property, you're going to use that to allocate that in a different investment, so it's not meant for retirement now, and it must be taxed accordingly. You will only be taxed as capital income from the true income derived from that account. So again, you would separate that and you would only be taxed at 28%. However, with the NHR 2.0, in this case, since it's not pension, it's passive income sourced abroad, it means that it could get a full exemption in Portugal. I believe one last thing it's interesting to be mentioned, because a lot of people believe that with a full exemption in Portugal, my taxes in the US are also exempt. But due to the way that double taxation treaty works, through a system of credits of taxes paid here or in the US, if you don't get taxed at all due to the exemption of the NHR 2.0 in Portugal, it means that you will pay full taxation on the US level if we're talking about passive income. Okay, there are some margin if you have active income, if you have employment, self-employment, derived income. There's some margin for you to play around with the US legislation in this case, but not for passive income, which means that the NHR 2.0 would actually save you on taxes in this case, the difference in Portugal, which could be huge. Could be huge, depending of how much you are being taxed in the US. It could be a relevant amount, and we're talking about a 10-year long benefit. So it could save you a lot of money still, but it's good to mention how does it work on the US side. And one last thing, the double taxation treaty covers indeed the federal taxes from the US. However, it doesn't mention anything about state taxes or property taxes.
Okay.
So in this case, what you were accounting on bringing as credits to Portugal are the federal taxes from your federal tax returns.
We asked our patrons and our Patreon community to give us questions for this video. And one was, how does Portugal treat the exchange rate when we're talking about currencies for taxes?
So the idea with Portugal in terms of these exchange rates is to use normally the Bank of Portugal index for exchange rates in the day that a certain payment or distribution was made. If it's unclear when the income was actually distributed, you use the exchange rate of the Bank of Portugal, which it is the official exchange rate from the last day of the year.
Another question from a patron is, does Portugal have an inheritance tax, whether that's in Portugal or from abroad?
So Portugal doesn't hold a proper inheritance tax, but it does hold a stamp duty on any inheritance or donation that is received by someone who's a tax resident of Portugal. That stamp duty might not apply if your assets are not in Portugal.
Okay.
So the idea is if you get a deposit on a foreign bank account, or if you inherit a property that it's in the US, normally what will happen is that the US will eventually tax that in the inheritance or stamp duty level.
Now, if someone moves here and they're retired and they're on those taxes, but then they decide to take a part-time job and they start making some active income, what does that look like for tax filing?
So for tax filing, it makes it a little bit complicated. It creates a little bit more of trouble in terms of report, but in terms of taxation, it doesn't change a lot, especially if you only have pension like Social Security or government pension. All of that income will be aggregated in order to find the tax rate. So it's important to measure that if you already get, a very high pension, so in order to, do not get extensively into the 48% ecosystem, but at the same time, if, for example, you have a self-employment in Portugal, you should be due Social Security, but if you get benefits from Social Security, you simply don't pay Social Security if you have a self-employment income. So it's something that should be schematized and planned accordingly, but it's also not rocket science.
Well, with a lot of the changes going on with NHR 2.0, I think a lot of retirees are thinking, is it still worth moving to Portugal when I have to pay these taxes? Like, will my money still get me where I need to? So as far as taxes go, do you think it's still worth for a retiree to move to Portugal?
I do believe so, Kalie, and although we had the changes regarding the NHR that brought a marvelous scenario regarding even the pensioners, with the due planning, with the workarounds that we can do with NHR 2.0, with the correct treatment of your pensions under the domestic tax legislation of Portugal and the double taxation treaty, it will not be a huge difference. And if there is any difference, you might even save some money due to the local costs of Portugal not being that high as we see normally in the US. So if you're coming to Portugal with the idea that you are going to a tax haven, perhaps it will not be like that. But if you were coming to Portugal and you were afraid that Portugal or any European environment will, get a lot of your money on taxes, I don't believe that will be the case. I don't believe that it will be a huge shock. As long as you plan yourself accordingly, try to plan yourself in advance in terms of what to do, how to do, what to track, what not to track, what to do with my retirement account, should I allocate here or there. We can all give suggestions regarding it to make your life easier in Portugal.
Okay, thank you, Pedro. And now you know about taxes, but you need to dive deeper into NHR 2.0. So for that, check out this video right here and don't forget to subscribe. Now let's get moving.